Hey everybody, it's Chris Robinson, Robinson Ag Marketing with today's post-close grain and livestock comments for the second day of June, 2026. I think the story of the day was more sell pressure. You saw some technical levels tested, but you did see a lot of fund selling. So this is the third day of fund selling. Historically, that's what they'll do. It takes them 3 days. They started selling on Friday. And today is Tuesday, so hopefully they're done now. They sold 12,000 corn, 12,000 bean, 3,000 meal, 7,000 bean oil, 5,000 wheat, and I've pushed this down here. A pretty good correction. If you're not getting my letter, you can see all the technical levels. Some people get bored with charts. I get bored with charts as well. They can also, they're not perfect. When you look at these retracements that I run every day, they're always also a judgment call because people always point out rightly that, it depends on which lows you use and which high you use. Generally, though, I stay with the longer term ones. So if you do what a retracement for December new crop corn, and you just use this year's low, which was the January report low, 445 roughly, and then the high at 6.5, 506.5. 468 and 3/4 is very important. It's a 62% pullback. We did fall down to nearly 465 today. We didn't test it, but we got close. We settled at 66.5. We did trade as low as 65.5. That's the lowest price we've seen since February 26th. So, certainly a correction. Hard to believe that it wasn't that long ago, May 12th, 3 weeks ago, we were at 506. Now, did you reward it? Did you use it to make cash sales? Did you use hedges? Everybody's got a different story, right? The hedges that we have on, we had 480s, 475s, 470s. I did send out a recommendation today if anybody had those on the books to look to roll them down to try and take profits on them, because just as quickly as this stuff has gone down, if anything changes, we could rally back tomorrow. What you don't want to have is an option that you paid 7 or 8 or 9 cents for that's worth 20 to go worthless. So take money off the table or use that increase in value to get yourself more time. So if you had an option that had 25 or 26 days left on it, we tried to get you out to 52 days. Maintain the floor. We don't want to lift the hedge, but you want to be in a situation that if and when we do recover, you have a cheaper put go worthless than an expensive one. And at the end of the day, my program is geared really towards farmers and producers who you're already bet long. Your call options are in the field. You may have some call options on for stuff that you sold, but your biggest risk right now is unpriced grain. So maintain your protection and try and get more time if you've got those puts on. 466.5 is where we settled. July corn, spot corn, held it again at 440. That's a little bit different ball game. And one thing with these algorithms, they tend to front load everything towards the spot month. So you see July corn dangerously close to the January 16th low, and which came after that USDA report on the 10th. That low was 433.5. Today's low was 39. So we're within a, certainly a hop, skip, and a jump to testing those lows. So again, same idea. Depending on where you are with your old crop corn sales, in our program, we tried to get them all sold when we were up there at 85, 86, 87. And for guys that wanted to hold them, though, we did have puts on the books. Again, same idea. If you've got a put that has jumped a bunch of value here, manage it. Try and get more time on it if you need it. July wheat hit sub $6 today, $5.99 a. It did settle at $6.03. But again, taking some sell pressure there as well. Hard to believe, again, that back on the tippy top there in the middle of May, we were nearly at $7. We hit that high of $6.88. If you run the retracement on that move, the low of the year, let's just use $5.25, and the high at $6.88. We are right there at halfway back. $6.06 is halfway back of the entire year. And we're going to see if, are we oversold? Are we done? Are we due for a bounce? That's why we're going to roll down these puts if we can. And in soybeans, probably, the fact that we're still above 1175 beans has got to be a victory. That contract remains the most bullish looking chart of all the new crop bushels. 1178, 75, this area. Very, very, very important. If you take the low of the year, which is basically 1055, and run it up to the high of 1214, this 1177 and 3/4 area, and again, I've had this in the letter here for the past really 2 weeks, 25% pullback of that entire move. So the fact that it continues to hold in there is probably the one bullish thing. I will say this. What am I worried about if I'm a bull? I'm worried that if the funds give up the ghost in new crop beans, it could really pressure the rest of the row crops. So watch new crop soybeans. And again, if you've got nothing sold, if you've got nothing hedged, this is probably your third or fourth or fifth mulligan to get something done. You don't want to be the person at the end of the year, if we drop back down to 1050, who sold nothing, hedged nothing up here. Selling a hedge is not calling a top. Making a cash sale is not calling a top. It's rewarding revenue where you get a chance to do it. Now, if you're absolutely positively sure that the moment you sell corn, wheat, or beans, that's going to be the low, and a week later we're going to be 30, 40, 50 cents higher, then by all means, make the cash sale and re-own it on paper with a call option. I'd rather see you re-own it with a call option than get long futures, because if you get long futures after a cash sale, basically you might as well have not made the cash sale. Moving over to the livestock. More news and headlines potentially about screwworm. You did have June cattle hanging in there pretty good, though. I mean, a lower day, but if you look at that June fat cattle, 247.5, still doggone close to 255. So if you've done nothing there, there's still time to do something. You don't want to be in a situation where we drop back down to 225 or where we were in November, just above $2 when we hit $2.32 back in November of November 25th, actually, right around Thanksgiving, oddly enough. So that big correction, I think, left a mark, and you don't want to be in a situation where you get run over like it again. Same thing for feeder cattle. Feeder cattle hitting some very big technical levels. It did look like today like they were going to take a shot at making new lows. We opened up. They pounded on it earlier. It looked terrible. It looked like we might take out 344. We finished the day at 348.5. If I'm long feeder cattle, that's the number I'm worried about, 344.27. If that fails, that opens up our run down to look below 340. So watch those levels. Pretty good action in the hogs. A wicked turnaround. We're going to dig into this later on tonight in the letter, but we did make a new low for the move in July hogs, the lowest price really since December. So I'm going to call it a 6-month low, guys. 7-month low, really. We traded as low as 98.30, turned around and settled the day up at 101.60. This is why we roll puts down. We try and roll them down because when and if we get the spike, a week from now, if we're back up to 110 or 112, and if you've got a bunch of dollar puts on here or 99-cent puts on here, and you didn't take them off when they were worth a lot more money, that'll be frustrating. So if you've got good value in those puts, consider rolling them out and getting more time. If the lows are in, great. I'm not telling you to lift your puts because I'm not telling you the lows are in. But if you've got a put that's gained a bunch of value, if today was the turnaround, use the value of that put to get yourself some more time. That's what I would do. I would not lift the hedge, though, because we've seen this before where we get these rallies, and then 3 days later, we're making new lows. So all in all, it was a continuation of money flow leaving the long side of the ags here today. Crude oil. Surprisingly, we've had this disconnect. Crude oil is back up to $93, $94. Not really pulling back. And this is the first time in a while where we haven't seen the grains go with crude oil. So you've got that disconnect. I just think it was overwhelmed by the speculative funds And they tend to do that. They tend to do their selling in tranches of 3 days. So we'll see if tomorrow we didn't get a turnaround Tuesday today. Possibly we'll get a turnaround Wednesday tomorrow. So keep your powder dry, keep your risk on paper, and we'll look for better markets ahead. This is Chris Robinson, Robinson Ag Marketing, 312-638-8868. If you're looking for help, take a look at my letter, Robinson Ag Marketing. If you need help with your selecting your hedges, pretty much my program is turnkey. I make specific cash flow recs. I also make specific hedge recommendations. And then once those hedges are in place, I do help you manage the value of them, especially if you're unfamiliar with how options can change value very, very quickly. I do make recommendations to try and take advantage of options when they do jump in value. Because when these volatile markets, an option can double or triple and then 3 days later be worthless. All right, guys, have a good night. This is Chris.